If you are using market structure shifts, then you have no idea what you're doing. Now, either that got you hooked or that got you insulted and you're running to the comments to insult me. Again, that is of course me over exaggerating, but there's a reason why I have an insane accuracy in my humble opinion. And I'm not even looking at market structure shifts. Well, we could argue that I have incorporated them into my trading plan. I just don't need to pay attention to them. So that is the lesson that I'm trying to teach you here today. Because if you remember the video with the title, How I Made $13,000 Trading Just Fair Value Gaps in a Single Day, this is the video right here that you're seeing on your screen that I'm talking about. And in there, I mentioned you only need fair value gaps. And the reason for that is a very deep-rooted psychology reason, actually. It's extremely important. If you can turn two rules into one singular rule, then you've just taken away 50%. In other words, you've saved yourself 50% extra attention, extra focus to focus on your psychology now, which is extremely beneficial, of course. Because we all know trading is all about psychology, but again, nobody actually pays attention to it, and everyone is trying to sell you a new concept, a new fancy concept, where I will also show you my concepts that I use. But the reason I'm using these concepts, the technical analysis here, is helping you on your psychology side as well. And that makes it so extremely special. So the first thing we actually need to understand is the float and the lot concept. So here we are on Canadian dollar CHF. We have a float and a lot concept, with float standing for first line of defense and lot standing for last line of defense. What does that mean? When I'm referring to this, I am referring to a single leg. So right here on Canadian dollar CHF, we are seeing certain price action. And on a monthly time frame, we are having a fair value gap lower. We also have this swing high right there. That swing high alone in a bearish situation has created a lag lower. So to understand lags and where lags happen, again, a bearish lag needs to have at least a swing high. A bullish lag needs to have at least a swing low. Those lags also need to have a fair value gap in them. Remember the video where we went over high probability lags? This is a high probability lag. Now, what does that mean, high probability? As in, what makes it high probability? The fair value gap right there makes it high probability. And high probability as in, if there's a fair value gap in the lag lower, it makes it high probability that the high right there will not get swept. So will not be traded above before we continue lower. Unless, and there's a very specific condition, unless there is a fair value gap hovering above that leg on the time frame above it. Which in this case, I don't go higher than the monthly time frame. So for me, there's nothing above it right there. But if this was the weekly and there was a monthly fair value gap hovering above this leg, then this would not have been a high probability lag lower. So now we understand that this is a high probability lag. All right, how do we then incorporate the float and the lot concept? The float stands for the first line of defense. What is a defense in that case? A defense is a PD array. So if we are expecting lower prices, you are always expecting lower prices off of what? Off of a premium array. So that premium array in a bearish situation is a defense. Is a defense mechanism of price to avoid bullish prices. So to avoid being bullish, premium arrays will be defending price to actually continue lower. So understanding that, then the PD arrays that we are seeing in this leg lower right there are what? Well, that can be, again, dissected by understanding the float and the lot. Right here, you have the first line of defense. Why is that? Because that's an order block. Remember what's needed for a high probability order block? What we went over in one of the first videos after the A to Z guide. It was actually the first video. Then right there, we need a fair value gap lower in order to have a valid order block. So that is a valid order block only because we have a fair value gap in the leg. Then after that, we have this right there, this fair value gap right there. So understanding that this line that we have right there of the order block is the first line of defense, because it's the first premium array that price will encounter if it wants to retrace and before it wants to continue lower. Then the second one is this fair value gap. Hey, that means that we have an order block and a fair value gap right there. That means that that is the odd. In between your first line of defense and your last line of defense, you have an odd. The odd is your overlapping defense. That is where a minimum of 2 PD arrays are overlapping with one another. And then afterwards, you have your last line of defense, your lot. That is always a swing high right there. Now, I want you to pay attention to a certain thing right here, because I mentioned 2 things. I mentioned that this would not have been a high probability lag without a fair value gap lower. That would not have been a valid order block or a high probability order block if it wasn't for that fair value gap. So what is the superior PD array? It's the fair value gap. The fair value gap makes the world go round. You could call it. The fair value gaps are the reason why the market is doing what it's doing consistently. Without that fair value gap, this would not have been a high probability lag lower. Without that fair value gap, that wouldn't have been an order block. So the most relevant thing, the superior PD array in that moment, is the fair value gap. So the fair value gap is again telling us that story. The fair value gap as well tells us how we should mark the order block, because I mark the order block from the body right there and not the wick. Sometimes you also see me mark the wick right there. If the pinpoint, the lowest point of that wick, of that order block, is exactly overlapping with a fair value gap. So right here, there should have been a fair value gap lower right there. So in that moment, if there's a fair value gap overlapping with this exact lowest point of that wick right there, then that would have been the low of the order block. That is the low that you would have marked for that order block. Since that isn't the case, what we're seeing, there's no overlapping fair value gap, then you always mark the body of the fair value gap right there. This leads me back to the story that we went over in the previous video of a fair value and liquidity reasons. So now the fair value gaps have told us everything again. All right, perfect. So the float and the lot concept is there. Why? It's there to benefit you to understand where price will likely not retrace towards, because price has no reason to retrace towards this high right there to then continue lower. So you're always, and this is, I call it in the mentorship, I have no idea if it's accurate or not, but it's like a science, right? It's like Albert Einstein, the relativity theory. It's whatever time frame you are looking at, that is where you would look at your high probability lags lower, because the lags, they change. If you change the time frames you're looking at, the lags, the high probability lags also change right there. The float and the lot also changes. So they need to be in context of one another, where the monthly will always rule because it's the highest time frame. The weekly needs to be in context of whatever the monthly is doing. That is very important to understand. So right here, this is where you would now expect a retracement towards a maximum of this high. And if we sweep that high, again, we need to understand there's a reason why it's called the last line of defense, because that is still a defense point. We wouldn't expect it to come all the way there to then continue lower, but it's still a premium array. It is still a defense point where price can continue lower from. So if we skip price a few points right there, a few candles, then we can see that we are slowly continuing lower. Now, I do have to admit, of course, this is not the nicest price action right there, but overall, it's still the exact same concept. Then at this moment in time, we can also see right there that we are not creating a fair value gap higher on the monthly time frame, because we are not creating that expansion phase of the monthly fair value gap higher potentially. If it would have done that, then what should it have done? It should have not retraced back towards this high of that candle right there. So this right there also confirms the idea again. All right, we definitely do want to continue lower towards this low right there. That is now your target. So in here, is there a premium rate to trade off of on the monthly time frame? No, not really. All right, so let's go down a time frame to see if we have the float and the lot concept again for our premium rate. for our narrative. So here we are on the weekly time frame. And again, this is the monthly target right here. These are the monthly PD rays, the float, the lot, the odd as well, that we can continue lower from. I'm going to remove them right now, just in the understanding that we already understand, all right, this is now the target right there. Just to gain a little bit more clarity, I don't like to have a lot of things on my chart. So at this moment in time, what is the float and what is the lot? Well, overall, we understand that we are continuing lower because the weekly needs to be in context of that monthly. So right here, we have the last line of defense that is sitting right there. And we also have the first line of defense that is sitting right there. You could argue it's an odd, an overlapping defense with the BPR as well, but just keep it simple at this moment in time. So the float and the lot leads you to the question, if we are going lower, where are we going lower from? It's such a simple question if you understand the float and the lot concept, that you will have great accuracy on knowing exactly where price will continue lower from or continue higher from. Because of course, if we're bullish, then all you're asking yourself is, if we are going higher, where are we going higher from? And if you do not understand the lags, so you can't refine on where we are actually going lower from, then of course, that is a very vague question. But we understand the float and the lot. So understanding the lot already refines the area to only this area right there on where we can continue lower from. And if we're not continuing lower off of that area, then what are we doing? We are continuing higher. And that is where reading the fair value gaps comes in again, which we'll have a beautiful example of later on in this video. So right here, all right, we can continue lower off of this fair value gap if we do want to retrace. Now, we do not get a retracement right there. And what do? We create a new weekly fair value gap. So what is the new float at that moment? The new first line of defense is now this right here. So if price wants to push towards this low, then it will use this fair value gap right there to continue lower off of that. If we are going lower, where are we going lower from? A very simple question with a lot of meaning behind it. It sets off a chain reaction of thoughts in your mind. So right here, we can come into the weekly fair value gap right there to then continue lower off of that. All right, now we have reached the target. Well, what can we do now? Well, if we are continuing lower, where can we continue lower from? We have a new float and a lot, because this is now our lot right there on a weekly time frame. And this is now our float right there, the fair value gap. We have an odd right there as well. And even these lows right there, they also act as an odd right there, overlapping with always a fair value gap. If we are going lower, where are we going lower from? This weekly fair value gap sitting right there. All right, that is very interesting because right now, let me refine the weekly fair value gap actually. It's this weekly fair value gap, of course, at that moment. Then that weekly fair value gap can cause us to push price towards this low right there. Let's dive into the 1 hour time frame to now look at how you don't need a market structure shift to get involved. So here we are on the 1 hour time frame and we have the weekly fair value gap sitting right there. We also have this target sitting right there. I'm going to remove the overlapping defense right there just to have a little bit more clarity. Again, clean charts also helps with your psychology. Then understanding that we are waiting for that weekly fair value gap to be hit first before we act on anything. Before we do anything, we're waiting for that weekly fair value gap right there. So here, the weekly fair value gap is eventually traded into right there. Perfect. Now, all we need, and I already know my entry pattern, and for the people that are in the money making team, in the mentorship, they perfectly know my entry pattern right now. Before I even went into the 1 hour time frame, I already know my entry pattern. It's 2 high probability lags lower on the 1 hour time frame. Now in the mentorship, and if you combine the time frames correctly, which you don't necessarily need the mentorship for, then going up a time frame and blatantly copying me, just seeing what I do. If you follow along with the videos, you understand already which time frames I'm using. Because if you go up a time frame, you only need 1 fair value gap lower, only need 1 lag lower. So what does that mean? Only needing 2 fair value gaps lower. Because this is where a misunderstanding was. And again, that is my responsibility because I did not explain it correctly. I mentioned I only need 2 fair value gaps lower. That is not 2 fair value gaps in the same leg lower. Because we understand that for a leg to be created, for a high probability leg to be created, I need a fair value gap in that leg. So when I refer to those 2 fair value gaps, I'm referring to those 2 legs. Because a leg needs to have a fair value gap. So essentially, I'm just waiting for a new fair value gap lower. So that is why I say I need 2 fair value gaps lower. So here we have 1 fair value gap lower right there. This is the first fair value gap. Now, off of that first fair value gap, I would like to have a new fair value gap lower being created again. That new fair value gap lower right there in itself, the creation of the fair value gap is already an entry. But first, let's dissect this again. Because what did we do? This 1 hour right there created this lot, the last line of defense that is sitting right there. Then we also created this float that is sitting right there. And we have a breaker. So that is the odd. So that is our high probability leg lower, the first one. Since we are using the 1 hour time frame here, I want to wait for another high probability leg lower, which is just, again, a new fair value gap lower. So this new fair value gap lower that is sitting right there, that fair value gap lower is now the confirmation that we can get involved. You can either wait for the fair value gap to be traded into right there, or you can already execute on the fair value gap being created. Again, that is picking your poison. Which one do you want to use right there? At this moment in time, you can cover the lot right there and you can look to target those lows right there. Now, you might think I'm cherry picking this entry right here. Why are you not picking the sting into the fair value gap right there? Because clearly at this moment in time, it did not fully sting into the fair value gap. So you're cherry picking it. No. Because in the mentorship, we understand fair value. So we also have a great indication of understanding which fair value gap actually wants to be traded into, leading to a potential breakaway gap, which you can also understand by understanding the float and the lot. Because at this moment in time right there, you also, what I didn't mention yet, is you have this mitigation block, which is your first line of defense. The first line of defense is called the first line of defense for a reason, because it might be the first premium rate that already pushes price lower. So that right there, the first line of defense, could already be your entry, because the first line of defense might prevent sometimes that we will be trading into the fair value gap. But all we did right there is waited for 2 fair value gaps to get involved. Now, probably realistically seeing this candle right there, you probably would have still likely gotten involved right there. It's perfectly equal highs. But again, doesn't matter. It's again, just understanding the full premise behind it. So right here, you target this low right there. Or you can just very easily target a nice 1 to 2, which eventually right there, we delivered very nicely. Now, what did we just do? We just looked at an extremely high probability entry, because this entry is so extremely high probability that we didn't need to pay attention to a market structure shift. And this is exactly why we don't need it. Because yes, I can understand. And if you understand market structure shifts, I don't need you to study it. But we understand that the market structure shift happened right there. And we also understand that a lot of times it's being said that in order for us to have a valid market structure shift, we need a fair value gap in the leg lower. So if I hear that correctly, in order for us to have a valid market structure shift, we need to have a fair value gap. So if I hear that correctly and my logic makes sense, and correct me if I'm wrong, then we actually can look to use the fair value gap without needing the market structure shift. Yes, the market structure shift happens, and I'm not ignoring that. And a market structure shift is not a bad thing, don't get me wrong. It's just not needed. Because here I used market structure shift without paying attention to it. It was already incorporated into my trading plan. And then what was already incorporated as well was just time, because this fair value gap and both fair value gaps happened during a kill zone. And I didn't even need to look at it. I just needed to wait for a fair value gap right there, because Asia wasn't going to create a fair value gap, because if you understand Asia, it's a range. It's likely a consolidation most of the time, but sometimes it can just create a fair value gap as well. It's about wherever the volatility is, and the volatility is seen by fair value gaps, because fair value gaps equal displacement. There's a reason why we do the things that we do right here on this YouTube channel. Everything has a logical reason to back it. And if you understand the fair value gaps again, then what did we do right here? We traded the market maker sell model. I didn't even mention it once. So through fair value gaps, again, we incorporated a market structure shift, market maker sell model, power 3, kill zones, probably our 90-minute cycles, probably some quarterly theory. And all we did was, again, looking at the fair value gaps. And this is also the reason, because if this would have been a daily fair value gap right there, in the previous videos, I only needed this fair value gap lower right there to tell me when to enter, which this is an ST entry. It's an extremely accurate entry, which is also, if we understand fair value gaps, we can enter before a market structure shift even happens, because we understand fair value gaps and we only need them. All right, so I want to go over one last example right here, because as we mentioned, we came, of course, into this 1 hour fair value gap with the 1 hour breaker that is sitting right there. Now, do we need to wait for the 1 hour fair value gap to then trade the 1 hour right there? No, because I know a lot of people also don't want to trade the 1 hour right there. So what would you do? You can go into the 5-minute right there, and all you would need to do is wait for a 5-minute fair value gap lower. That's it. So right here, if we go into the 5-minute time frame, what are we seeing right there? A 5-minute fair value gap right there that we trade into, that we can enter off of. Perfect. Covering again the lot to target are nicely 1 to 2 right there. And this is exactly how you go over fair value gaps and why you don't need a market structure shift and a lot of other different concepts that are thrown at you. And again, the reason behind that is combining 2 rules into 1, because that allows us to have more attention, more focus on our psychology as well, which is really, really beneficial. Believe me, if you have a shit ton of money on the line, you don't want to pay attention to, do we have the market structure shift? Do we have the market maker model? Do we have the power 3? Ooh. No. You want to keep it very, very simple. So just a little announcement as well. We are transferring to a new website as we speak. A new website for the money making team, which is going to be, again, a big game changer, because it allows us to have a lot of different features that we previously did not have. So that means that currently on this Saturday, the 2nd of December, monthly options might still be closed, but once they open up again, I will announce it on my social media, and I will also mention it in the next YouTube video and during the live streams, of course. We're looking to open up again as soon as humanly possible. And then I'll see you tomorrow at the Sunday weekly forecast. Perfect. Thank you.